We're in Toronto with 35,000 other people for the world's largest mining conference, the PDAC. Joining me now is Dr. Martin Murenbeeld. He's the chief economist for Dundee Capital Markets. Welcome back to the show, Dr. Murenbeeld.
It's a pleasure.
Now, last time we spoke was in October, and we were talking about gold price, and you were calling or looking at $1,335 gold, and we saw gold reach $1,300 in January. And I guess my first question before we talk PDAC is, how do you see the gold market set up right now?
Well, we put out a forecast, as a number of forecasters do, in January to the London Bullion Market Association. They do a big roundup. And the number that we put down for this year as an average is $1,255. And I'll tell you how we got there. The computer models that we're running suggested something in the neighborhood of $1,237. I thought, well, okay, that's fine. But what happened last year in January, we put in $1,250. And the gold price averaged $1,266. And as we do each year, then we go back and say, okay, what did we forecast and what happened? And it turned out that if we can scrub out the impact on the gold price of the Russian takeover of Crimea, which added on average $16, as it turned out, to the price of gold, we would have had a perfect forecast. So when I submitted this year, I said, okay, I'm not going to make that mistake again. I'm going to add some $20 approximately for geopolitics and financial crises. So that's the number we have for this year, $1,255.
And right now we are seeing gold really just moving sideways here, and some are attributing it to the fact that there's the expected Fed rate hike, where other analysts are saying, no, look, that's already been priced into the equation. Mm-hmm. How do you see it?
Well, first off, gold has come back a little bit from what we call a little bump that we've seen in the price, and that again is related to the Ukraine as well as to Greece. I think that impact is now out of the market. The ceasefire, touch wood, seems to be holding in the Ukraine, and Greece and the EU have made peace. So gold has kind of come back to around this 1,200, 1,210 level, which our models tell us at the moment is about right. Okay, with respect to looking forward, we personally think that the gold market basically got ahead of itself in 2013 in the taper tantrum. Mm-hmm. Okay, we saw the real interest rate, the real long-term interest rate in the US rise, and gold got sold off hard. Now, the sellers were hedge funds selling ETFs. Okay, there weren't many of them, and when I've talked with them, I get the sense that they said, look, the Fed's going to tighten at some point. Europe isn't falling apart. The S&P is shooting out the lights. We're moving over. We actually like this gold story, but we're not making any money in the gold story at the moment. So all of that I put together and I say, you know what? I think people have more or less discounted. Now, nobody at this point can be surprised when the Fed raises rates 25 basis points. And by the way, what is 25 basis points? I mean, it's like an absolute nothing with respect to impact on the U.S. economy. So it's really an announcement effect, and we think that the market has discounted it.
And how about if we look at central bank policies globally now? It doesn't seem that everyone's marching to the same tune. We saw the surprise move by the Swiss, which really caught everyone off guard. What kind of impact could this have on the price of gold?
Well, we have a number of central banks now, the Swiss excluded, Swiss National Bank, that are at the point of QE or at the point of more QE. So you have the ECB now, you've got China at the point. China is, as you know, loosened monetary policy a little bit more over the weekend. So we got a number of central banks that are loosening. Now, by rights, that is good for gold in the currency of the central bank that's loosening. So that's what we've seen as well. We've seen gold go up against the euro, gold's gone up a little bit against the RMB, gold has gone up a lot against the ruble, etc. Okay? So now the question really is the Fed. Okay? Now, it's a thesis of ours that gold could actually rise against the dollar, even though the dollar rises against other currencies. And the way that would come about is if the Fed stays loose, but just not as loose as the other central banks. Okay, and that's kind of actually what we saw last year a little bit.
Right.
We saw gold pretty flat against the dollar. I mean, on an exact year-end to year-end basis, it declined just over 1% against the US dollar, but it went up against every other currency. So our forecast is actually that gold will go up a little bit against the US dollar because the Fed isn't really going to tighten in any significant manner, and it's going to go up that much more against other currencies.
I guess to wrap, I mentioned at the start, we're at the world's largest mining conference. What's the sentiment like this year for you?
Well, the sentiment I feel is it's constructive. I've talked with a number of people that I respect highly with respect to their analytic capabilities on the various metals and so. And we have been telling our clients, this is a good year to start averaging in again into the resource sector. And I'm getting a sense from others that that is, in fact, something that we ought to seriously think about. So to the retail investor, I say, start thinking about dollar averaging in to the resource sector. And obviously, if you were early, well, you stay with it. I was out of the resource sector for a number of years, and I'm myself averaging back into the resource sector.
Do you think we're at a bottom?
I think we're at a bottom. Now, that doesn't mean that we're at a bottom like nothing will go lower than right here. Right. But, when we look at backwards 2 years from now, I think we'll say, hey, the bottom was 2015, thereabouts, yeah.
Dr. Murenbeeld, thank you so much for your thoughts. Thanks for joining us, and thanks for watching our coverage here from PDAC 2015. We'll have more for you, so be sure to stay tuned to Kitco.com. Thanks for watching. Thank you so much.